Hello everyone, my name is Michael Ruger. I am the managing partner of Greenbush Financial Group, and the reason why we're doing this video today is we've heard of a number of individuals that are starting to get letters in the mail from their insurance company. These are people that have long-term care insurance policies, and they're getting these letters that their premiums are about to go up by 30%. 50%, and in some cases we've heard 100% increases in the premiums in a really short period of time. So it's left these individuals to say, should I be doing something different with these policies? Should I just pay the higher amount and keep this policy in place? Others are thinking, do I make amendments to the policy to lower the cost or at least lower the increase, saying, do I ask them to essentially reduce some of the benefits so I can continue with this policy going forward? Or others are asking, should I just get rid of this thing? If the premiums are going up by this much and they could keep going up, does it make sense to continue on? So I'm going to walk you through some of the guidance we have given to some of our clients. Unfortunately, the bad news hasn't just stopped at the premiums going up, but also there's been information in some of these letters actually questioning the long-term solvency of the insurance carriers that are backing these long-term care policies. And also other letters have gone as far as saying we have to increase premiums significantly, not just now, but over the next 5 years. So here are some of the word-for-word statements that we've seen in some of these letters. So the first one being, this represents a 69% rate increase in the premium of your policy. A second one was, AM Best has downgraded its rating of the insurance company's financial strength to C++ in September 2019, indicating that AM Best's view of the insurance company has marginal ability to meet its ongoing insurance obligations. Not good, obviously. And the third one being, please be aware that as of June 6, 2021, over the next 3 to 6 years, we are planning to seek additional rate increases up to 250% for lifetime benefits. All things that have been kind of stated black and white that are making policyholders very nervous. The unique thing about long-term care insurance is it really isn't cheap to begin with. So before even these premium increases started, it wasn't cheap. If you were in New York and you wanted to get a decent long-term care policy, an individual was probably paying somewhere between $2,500 and $4,000 per year, and that's before these increases happen. And the reason why this insurance is so expensive is the payouts are large, but also there's a high probability that if you have one of these policies, that it's probably going to have to pay a benefit at some point. Because HealthView Services did a study in 2021, and basically what it found was if a married couple reaches age 65 together and they both have one of these long-term care policies, one of those two, there's a 75% chance that they will have a significant long-term care event that will cost large dollars at some point during their lifetime. And there's actually a 25% chance that both of them will incur a long-term care event at some point during their lives. So again, high probability that something's going to happen, high cost coming out, which means the insurance carriers have to charge more in order to sustain the premium dollars coming in versus the benefits going out. Now with these big premium increases coming through, it's becoming an affordability issue for a lot of retirees. Because if you think of most retired couples, they have set assets, set income. If you all of a sudden increase their long-term care insurance premiums by a few $1,000s a year, a lot of retirees might look at that and say, I can't afford to do that. I can't afford an extra $3 or $4 grand a year to maintain this policy. So then you're kind of faced with two options. The one option is I just cancel the policy, no longer have coverage, but I don't have the expense. Or the second option is I contact the insurance company to essentially amend the policy to have a lower benefit, which could not necessarily not cause an increase, but it could reduce the amount of the premium increase going forward. And some of the amendments you can make to these policies to reduce the cost are, you can extend the elimination period for the policy. You could reduce inflation riders. You can reduce the daily benefit of the policy. You can reduce the maximum lifetime benefit that the policy offers, or you could reduce maybe some home health care options that are associated with a policy. But you have to remember, you start making these reductions, you are decreasing the overall benefits that are going to be there down the road when this thing might have to pay out. So you naturally have to ask yourself the question, if I have to reduce this thing by too much to make this affordable to me, is this going to pay out enough for it to matter when I have a long-term care event, whether that's 5, 10, 20 years down the road? If after evaluating all of these amendment options, it seems like this policy is just not going to maintain enough benefits for the dollars you're still going to have to continue to pay over the years, you might then go to the other option, which is I might have to consider just canceling the policy. But obviously the risk with that is if there's a long-term care event down the road, you essentially have no coverage. So you have to develop an alternative strategy to manage those risks. And the two most common strategies is someone has to cancel policy to say, okay, now how am I managing long-term care risk? It's usually either self-insuring or it's setting up a Medicaid trust, and we will review those next. First, let's look at the self-insurance option, which is essentially if you decide to cancel this long-term care policy and now it's on you to manage the long-term financial risk of it. If let's say you are paying $4,000 per year into these long-term care policies, what we will often have clients do is set up an investment account or a trust, continue to put that $4,000 per year in as if they're kind of almost self-funding. That pool will build up over time, and then if down the road there's a long-term care event, now we have assets to pull from to help subsidize those expenses, and we've kept them separate from the other retirement assets that they're actually using for their regular spending. So keep it separate, but what you really have to do is forecast out and say, hey, if I have this amount going in every single year, assume a reasonable rate of return, what is going to be the amount estimated to be in that account at various ages? Because you really have to assess that and say, hey, if at age 85, I will have built up $300,000, $400,000 and you think that's sufficient, then it might be a viable strategy. Versus if you look at age 85 and you say, well, there's only going to be $40,000 in that account, that might not be enough to really manage and subsidize that risk. The second option is to set up what's called a Medicaid trust. And the idea behind this strategy is if you don't have long-term care insurance and then a long-term care event happens down the road, normally you would have to spend down all of your assets, so essentially paying for your own care until all of your assets are to a very low, almost depleted level. Then Medicaid will step in and start paying the nursing home or assisted living on your behalf. But when you set up a Medicaid trust and you do this ahead of time, you essentially place your accountable assets in this trust. If they're in there for a certain number of years and then a long-term care event happens down the road, they can no longer make you spend down your assets and you automatically qualify for Medicaid. And this is a whole completely topic in itself, but I'll put a link to a video below that covers how these Medicaid trusts work in more detail. The other item that really has to factor into this decision as to what you're going to do with your current long-term care policy if you get one of these letters is the reality that there's probably a high probability that the long-term care insurance premiums are going to go up more in the future. A lot of these insurance companies are putting it right in their letter. So it's one of those where even though you might be able to take this first big increase, you have to say, well, what happens if they increase by another 50 or 100% within the next 5 years? And that should really factor into the decision you're making today. Now let's look at what's actually causing these premiums to go up and up and up. So essentially, this isn't something new that just started. This has almost been 20, 30 years in the making, because when these insurance companies have been issuing these policies for the last few decades, they underwrote them all wrong. They didn't anticipate people would be living as long as they are, and the older we live, the more frail we get in our older age, and the higher the probability that a long-term care event is going to happen. Plus the cost of these long-term care events have gone up and up, so the outflows of these insurance companies are way more than they thought they were going to be, which is why they now have to request more inflows from the current policyholders. The second issue is there's just a lot less competition in this long-term care insurance marketplace. There are not many insurance companies. Many of them have already left because they don't want to operate in the sector of the insurance market where there's a high probability of payout and those payouts are large. Insurance companies want to operate in sectors of the market where they get to collect premiums and then they never have to pay anything out. This market is like the opposite of that. So for example, in New York State, there's only 2 insurance companies left that are issuing new traditional long-term care policies. So less competition, prices are normally higher. The third and final issue is they're just issuing less long-term care insurance policies because it's putting it out of people's affordability range. If, let's say 10 years ago, a married couple could get 2 policies totaling, let's say, $4,000, but now that's $8,000. You're just going to price this out of reach of a lot of couples going forward. So naturally, if there's not new money coming in, those current policyholders are going to have to keep subsidizing the additional costs. It's for all these reasons that if you are a long-term care policy owner and you get one of these letters in the mail that tells you your premiums are going up, you should really pause to evaluate all your options now. Do not just blindly pay the higher premium, because what if those premiums double in 5 years? You don't want to look back and say, I wish I did something 5 years ago. We also say use a professional to help you evaluate your options, because if you make changes to these policies or cancel a policy, you might not necessarily go back and be able to reverse those decisions. And also the solutions are, individual by individual, which means maybe continuing on with a long-term care policy makes sense for one person, but actually canceling the policy and going the trust route might make sense for another. I hope this was helpful. Feel free to reach out to me at moneysmartboard.com with any questions. Thanks.